Hi everyone. A finance professor who spent decades telling people to stay invested just announced he's moving everything to cash and baseball cards. That should terrify you. 3 silent signals are flashing right now that separate wealth protectors from wealth destroyers. This isn't the news you'll see on CNBC. This is institutional data that moves billions before retail investors even know what hit them. Before we dive in, remember, this isn't financial advice. All investing carries risk. Do your own research. Let's get into it. Signal number 1, follow the smart money, not the crowd. Major institutional surveys consistently reveal a pattern most investors miss. When 60% of professional investors express concern about market stability, while 73% simultaneously expect prolonged volatility, they're not guessing, they're positioning. State Street manages $49 trillion in institutional assets. Their risk appetite indicators measure actual buying and selling patterns across thousands of institutions. When these indicators shift from elevated levels to neutral territory, it signals one thing. The smart money isn't panicking, they're rotating. The rotation shows up in the details. Defensive stock demand surges, but selectively, healthcare receives institutional capital while utilities and consumer staples get ignored. The selectivity reveals sophisticated positioning, not fear. Institutions cherry-pick quality rather than flee markets entirely. Rowe Price documented a striking pattern across multiple market downturns. On days when markets declined more than 1%, value stock outperformed growth stocks every single time. Every single time. Institutional algorithms detected this pattern and positioned accordingly. Retail investors still chasing growth. Signal number 2, the valuation mirage hiding in plain sight. The S&P 500 trades at 21.5 times forward earnings. Most analysts stop there and call it expensive. They're missing the critical comparison. 10-year Treasury bonds yield 4% risk-free. The S&P 500's earnings yield sits at 4.65%. Do the math. You're earning 0.65% premium for taking equity risk instead of holding safe government bonds. That's microscopic. Goldman Sachs surveyed insurance professionals who specialize in risk assessment. 52% identified inflation as a major threat. 48% flagged recession risk. These aren't bloggers with opinions. These are actuaries whose careers depend on calculating probability correctly. They're hedging both directions simultaneously. Consumer sentiment indicators drop to multi-month lows during periods like this. The fascinating part isn't the decline itself. It's the divergence in investor behavior. Half the market stays fully invested in growth stocks. The other half rotates towards safety. Nobody occupies the middle ground anymore. Markets don't crash when everyone expects them to crash. They crash when one half of the market suddenly realizes the other half had it right all along. Elevated price-to-earnings ratios show weak correlation with short-term market movements. Research confirms this repeatedly. Valuations can't predict what happens next month or next quarter, but they excel at predicting the next 5 to 10 years. Current valuations suggest below-average returns ahead. If you're expecting double-digit annual gains from here, reset those expectations now. Signal number 3, concentration risk reaching critical mass. 40% of the S&P 500's entire market capitalization concentrates in just 10 companies. The Magnificent Seven, tech giants, dominate index performance completely. Run the scenario. If those top 10 stocks decline 40% in a correction, nothing else matters. Small caps won't save you. Industrials won't save you. International stocks won't save you. The ripple effect drowns everything. Ashwath Damodaran teaches finance at NYU Stern. He is known as the Dean of Valuation on Wall Street, and he spent decades being bullish, telling people to stay invested, believing in market fundamentals. He stated the chances of a catastrophic market and economic crisis may exceed anything we've seen in 20 years. He's considering moving his entire portfolio to cash and collectibles. When someone that bullish for that long starts talking about baseball cards as an asset class, you should probably pay attention. The AI investment boom requires $4 trillion in annual revenue to justify current stock valuations. The actual AI products and services market generates tens of billions today, not hundreds of billions, tens. That gap represents either the greatest investment opportunity in history or the biggest bubble since .com. Both can't be true. Companies trading at premium multiples would need to maintain 80% gross margins permanently on revenues exceeding $1 trillion. No company in history has achieved that combination at that scale. Not even close. Gold and stocks rarely reach elevated levels simultaneously. When both surge together, sophisticated investors are hedging rather than choosing. Central banks own nearly 20% of all physical gold ever mined. They've been net buyers, particularly in Asia. Central banks don't accumulate gold when they feel confident about fiat currency stability and government debt levels. So what do sophisticated investors do with these signals? 4 specific moves. Move number 1, build positions in quality dividend growers now before the rotation accelerates. Quality matters more than yield. Screen for 10 consecutive years of dividend payments, strong cash flow ratios, and healthy balance sheets. SCHD, the Schwab US Dividend Equity ETF, applies exactly this methodology. The fund screens companies on cash flow to total debt, return on equity, and 5-year dividend growth rate. It's currently yielding 3.9% with 8.65% dividend growth over the trailing 12 months. Compare that to the S&P 500's 1.2% yield. You're tripling your income while owning companies engineered to weather downturns. SCHD has averaged over 11% annual returns over the past decade through quality selection rather than speculation. The fund has underperformed growth stocks recently. That's precisely when to buy it. When crowds chase technology and ignore value, contrarians build positions. The crowd stays wrong at market extremes. Move number 2, rebalance with precision, not emotion. If your portfolio carries 60% exposure to mega-cap technology, you're dangerously overweight. Consider a structured 60-30-10 allocation. Place 60% in broad market exposure through total U.S. stock market funds or the S&P 500. Allocate 30% to defensive dividend strategies. SCHD fits perfectly here, or blend in VYM and VTU for additional diversification. Hold 10% in short-term treasuries or money market funds, earning 4 to 5%. That cash allocation provides dry powder for buying opportunities without sacrificing current returns. SGOV works well for short-term treasury exposure. Alternatively, use your brokerage's money market account. 5 to 10% cash won't destroy your returns. It might save them. Move number 3, become selective with growth exposure. Not all technology carries equal risk. Companies generating actual revenue, producing positive free cash flow, and trading at reasonable valuations exist in the growth universe. You must discriminate carefully. Avoid stocks priced for absolute perfection, where minor earnings disappointments trigger 20% declines. We've witnessed this pattern repeatedly across major technology names. Outstanding companies become terrible investments at excessive prices. Move number 4, monitor indicators that drive institutional decisions. Ignore daily market noise, track the VIX for volatility regime changes. Watch put-call ratios for hedging activity. Follow institutional fund flows through reliable sources. When major risk appetite indices shift direction, institutions are repositioning. When comprehensive investor surveys show majority expectations for prolonged volatility, defensive positioning becomes prudent rather than fearful. Markets reward preparation and punish complacency consistently. The signals exist now. Institutional capital is rotating. Valuations stretch historical norms. Concentration risk reaches extremes. You don't need to panic. You need to position. Strengthen your portfolio during periods of stability, not chaos. Add quality dividend growers like SCHD. Reduce excessive technology concentration. Maintain dry powder for opportunities. Build defensive portfolios before you need them, not during crashes. This content is for educational purposes only, not financial advice. All investing carries risk. Past performers don't guarantee future results. Consult a qualified financial advisor before making investment decisions. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.